Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead-in indicated, this is sort of a different take on the investment show. The objective here is not to provide investment advice. I'm not a licensed investment professional. Rather, I'm a securities attorney who dedicates his practice to representing investors in claims against brokerage firms. And the objective of the show is to pass along some of the information that I've gleaned through that practice that I think would be relevant to investors in aiding you in navigating that relationship. Your relationship with your financial advisor is a very important one. You're relying on that person to help you to either save for retirement, or if you're already retired, to protect your assets, provide income. And so it's a very important relationship. But unfortunately, we see instances in our practice where financial advisors take advantage of the naivete of the investor. And so the hope here is to pass along some of those, horror stories or examples so that investors out there will be better prepared to navigate that relationship, ask good questions, vet their financial advisor, make sure that they're with the right people. The brokerage industry is not unlike any other industry where there's great financial advisors out there, but there's also bad ones. And fortunately, there are great methods of vetting those people and making sure you're with the right financial advisor. And we've talked about it in previous episodes, but I feel like I should say it every week. The best way is to go to finra.org, FINRA.org, and in the upper right-hand corner there's something called a broker check. You type in your financial advisor's name, and it's going to spit out a report that's going to tell you everything you need to know about your financial advisor, whether it's your existing one, or maybe you're looking to establish a new relationship and you're wanting to vet a new person. But that broker report's going to tell you how they did on their licensing exams, how long they've been at their particular brokerage firm, whether they've ever been sued, whether they've ever declared bankruptcy, whether they've ever been criminally charged, whether they've ever been investigated by a regulator, all the things that I would think that you would want, and making sure you're with the right person. So, again, that's something that we talk about a lot of weeks, but to me, I wish every client knew that, because there's so many times where we get a phone call and we tell them, did you know that your financial advisor had been sued 25 times? And they're horrified. They had no idea. They didn't know that you could access that information. And obviously, if they knew that, they probably wouldn't have been working with that person, and they wouldn't be in the situation they're in. So check that out, finra.org. The topic for this week, though, in terms of some information that I wish investors knew, we're going to talk this week about ETFs, exchange traded funds. And I feel like it's become such a prevalent investment that it's almost ubiquitous, and everyone sort of assumes that they understand what an ETF is, what that means. But I see it a lot in our practice where investors don't necessarily understand the product. And unfortunately, there's actually ETFs out there that I don't think financial advisors fully understand, because the reality is ETFs, they're not all created equal. When it first started, an ETF was a low-cost way of tracking a particular index, whether it was the S&P or maybe it was sector-oriented. You wanted to track financials, and you could buy an ETF that did that. And usually you could do it for a very low cost ratio, often as low as 0.1%. And that was your traditional ETF. And I think when investors think of ETFs, that's what they're thinking of. That garden variety, the original ETF. And there's certainly benefits to that product. As I mentioned, it's low cost. The reason it's low cost is because they've removed the active money manager that you see in a mutual fund. In a mutual fund, you actually have money managers who are making stock picks. They're doing, very complicated analysis of which investments they think will do well. They're forecasting, they're analyzing, they're doing, charts and all of these things, and to pick 20, 30, however many investments in that particular fund. And you're paying that money manager typically 1%, maybe more, for that investment advice, for that active money management. And there's a lot of studies out there that say that regardless of how great your money manager is, it's very difficult on a year after year basis to outperform the market. And so when you factor in the cost ratio, 1% for the money manager plus your financial advisor on a mutual fund usually gets an upfront fee or maybe a back end fee, depending on whether it's a Class A or Class B share mutual fund. But the point is that once you start paying all of these costs, it's very difficult for the money manager really to bring added value, which would require them to outperform the market year after year in excess of the fees and expenses that you're spending. So that's sort of how ETFs started. ETFs removed the money manager and said, okay, we're just going to pick an index. We're going to buy the underlying assets. We're going to create an algorithm that keeps us balanced on, if the market moves, let's say it's an S&P fund and the market moves 0.2% that day, then we make adjustments so that we're still holding the same assets, but it's all done by algorithms. It's not done by an active money manager. And so because of that, they can keep the expense ratio low and essentially get it to a point where you're just tracking the market as opposed to trying to outperform it. And again, that's sort of your traditional original ETFs, the most common being the SPY. Vanguard's got one, Fidelity's got one, but essentially it's just an ETF that tracks the S&P 500. And so the performance of that product will match up almost perfectly with whatever's happening in the broader U.S. market of the 500 companies that comprise the S&P. There are others, of course, and now, as they've tried to get more specific and as the product has got more popular, there's really there's a ETF index out there that'll track virtually every particular indices. So that's where it's gotten more complex, and I think that's where the confusion gets in, is because now we've got products that are very different than your original ETF. And the problem, I think, is the perception that because, the original ETF was something that just sort of tracked a broader market, I think the perception is that ETFs are safe. So if your financial advisor calls you and says, hey, I'm recommending XYZ ETF, I think the perception of the investor is, okay, that's a pretty safe recommendation that I just got. And I think originally when ETFs were first being created, that was probably a true statement. But unfortunately, we've got all these sort of derivatives of original ETFs, and there's a broad spectrum now, and many of them are exceedingly complex, requiring a lot of borrowing, derivative trading, leverage, and there are actually some very frightening ETFs out there, which again, I'm confident that not all investors understand, but again, I've seen instances where I don't think the financial advisors understood the products. And you can get into some scary situations where you think you're buying a pretty safe investment and you're not. The keywords to look for when you're being recommended an ETF and you want to make sure that it is one of those safe ones, is be on the lookout for words like leveraged, inverse, daily, 3 times. Those are some of the buzzwords they'll use that is specific to ETFs they're actually highly aggressive. And I'll give you just a fact pattern that we've seen recently, and unfortunately it's one where the client suffered a great loss. But here's an example of where you can get stuck in a bad situation where you think that you're just getting a safe ETF. We've been speaking to an investor who, the oil prices, they were up over $100 a barrel as recently as about 18 months ago. And then mid last year, they were down around 60, and now they're at 30. So that's been sort of the progression of oil prices over the last 12 to 18 months. We spoke with an investor who, when the oil prices were around $60 per barrel, thought that it would be a good time to buy, oil prices going higher. That was what the investor wanted. So they called their financial advisor and said, I want to be long oil. Long means that you want the price to go up, as opposed to short oil, which would mean that you want the price to go down. So he says to his financial advisor, I want to be long oil. And the financial advisor spends some time, calls back and says, I've got this great investment that'll allow us to do that. And the investment was called, and I've got it written down here because to me, it rings warning signs. But again, this investor didn't pick up on those warning signs, so I'm convinced that there's probably other people that wouldn't have either. The product was called the Velocity Shares Daily 3 times Long Crude ETN, which is just another way of referring to an ETF. So it's got the buzzwords that the investor was looking for. It's long, and it's long oil, and it's an ETF. So the investor is thinking, okay, that's a pretty safe product. The problem, again, talking about those buzzwords, is really what that investment is. It is, again, the daily 3 times long crude ETF. And what's really happening with that product is that it's using leverage to try to create a 3 times return on what you're betting, which is long oil. And then it's resetting every single day. So basically what that investment really is trying to do is, if you think oil prices on tomorrow are going to go up $1, this investment is going to try to get you a $3 return tomorrow. That is what that ETF is actually for, which of course creates 3 times downside if you're wrong. But more importantly, it naturally erodes if you're holding it long term. It's not a long-term investment, which unfortunately is what this investor was buying it for. They thought over time oil prices are going to go up, which reasonably, when you account for inflation and commodities prices, is probably a decent bet. Even though oil's gone from 60 to 30 in the short term, at some point it will likely be more than $60 again. So not a risky bet necessarily, but in this product, enormous risk. Because the investor didn't understand it, and based on the fact that the investor held it, I'm guessing the financial advisor probably didn't understand it either, because of the way the investment actually works, is that you've got this leveraged component where they're trying to replicate oil prices, but at a 3 times return every single day, and then it resets and they do it again the next day. And they do that through very complicated derivative trading, borrowing, leverage. Again, these are some of those keywords to look out for. But it's a product that is down 65% since January 1st, and it's down 95% over the last year. So you've got oil prices that have dropped from about 60 to 30, 34, so that they're down about 50%, but the investment is down, it's almost been blown out. Over the last year, it's down 95%. So that to me is probably not, even if the investor understood, hey, okay, oil prices could obviously still go down further, they probably didn't think that they would be in a situation where they could lose as much as they have. And it's all because of that perception that ETFs are safe because they track a market. And again, the reality is that they're not all created equal. We've seen these products over the last few years. Again, some of those other buzzwords are inverse. That means that it's betting the opposite of what's happening. And so we've seen, clients who bought an ETF not realizing that it was betting against the market when the market moved up. The other buzzword is the leveraged one, where they didn't understand that it was actually that it was borrowing, to bet that the market would, let's say the market's going to go up and it's a leveraged ETF trying to replicate that. Whenever you have leverage and you have borrowing, you've compounded your risk. So if the market moves against your bet, your downside is higher than if you didn't have that leverage component. So just be on the lookout for those, because again, my opinion, based on the people that we've spoken to who have lost money in these products, and just generally in talking to people that I encounter, is that the assumption or the perception is that ETFs are a safe bet because, similar to a mutual fund, you're buying lots of different investments and you're getting broader base risk than you would get if you just bought one stock, and now you're exposed to the risk of that one company. And with a traditional ETF, that's true. But the reality is that segment of investments has grown so exponentially that now there's so many ETFs and they're not all the same. They're not all safe, and you just have to be on the lookout for it. The daily one, again, is another, going back to the original example, there are ETFs that are designed to only be held for that day. They're really for traders. They're not for, mom and pop retail, Main Street investors, because they shouldn't be held long term. They reset daily, and they naturally erode themselves over time. And so the bet can really only be a daily bet. It's for a trader who says, okay, today I think, there's going to be this OPEC announcement, and they're going to agree to cut production, and so prices are going to go up. And I'm going to buy it in the morning, and I'm going to sell it in the afternoon, and if I'm right, I'm going to make 3 times my money. That would be a perfectly reasonable bet for somebody who is sophisticated and understands the product, and maybe watches the oil market and is a professional trader. That is not a way to bet on oil prices going up in the long term. And again, unfortunately, that's what we see. So be on the lookout for that. If you're talking to your financial advisor about ETFs and they're recommending one that's got that buzzword or buzzwords, leverage, inverse, daily, 3 times, any of those, make sure to ask some questions, make sure you know what you're getting. We're going to take a break. When we come back, I'll pass along some more information that I think would be helpful to investors.
1-800-HI-MITCH. What's that number and who is Mitch? 1-800-HI-MITCH is the number for Mitch Maxfield's Carpet and Furniture Cleaning Services, serving Florida's Treasure and Space Coast for over 30 years. And Mitch still does the work all himself. Call 1-800-HI-MITCH. Mitch Maxfield personally will clean your home or business. Call now for 2 rooms of carpet cleaning for $77 or a 6-foot sofa for $66. Maxfield Carpet Cleaning is a member of the iTex trading community and welcomes your iTex dollars. 1-800-HI-MITCH.
Minuteman Press of Vero Beach, covering the Treasure Coast from Port St. Lucie to Sebastian, can handle all your printing and copying needs, from large format and blueprints to business cards and brochures, plus a full line of promotional products. Minuteman Press of Vero Beach. Google it.
Minuteman Press. Get a free quote. 567-4645. Minuteman Press is a member of the iTex trading community. Your iTex dollars are welcome.
You can trust Sandpiper Pest Control, serving Indian River, St. Lucie, and Brevard. Certified by the state of Florida to treat homes, lawns, and termites. Fully licensed and insured. Priced right, effective, and friendly.
Hi, this is Joel, the owner of Sandpiper Pest Control. Sandpiper can solve your pest issues. No contracts to sign, just results.
Call for a free estimate, 772-589-0204. Sandpiper Pest Control, a member of the iTex trading community. Your iTex dollars are welcome.
Welcome back, everybody. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Before the break, we were talking about ETFs and how they're not all created equal. And I gave you some things to look out for, including ETFs that talk about leverage, ETFs that talk about being inverse bets, ETFs that are traded daily, ETFs that say 3x in them. That means 3 times leverage, 3 times risk. So be on the lookout for those things, and just, again, the big takeaway is just understand that not all ETFs are the same. There are certainly very safe ETFs out there, great bets for people who just want to track the market, keep their costs low, and not worry about, daily, trading, buy and hold long-term investors. Unquestionably, ETFs have filled a huge need there, but there's so many more of them out there now, and they're not all the same. So just be on the lookout for that. The other thing I mentioned at the beginning of the show was how to vet your financial advisor and the FINRA broker check report that's out there on every financial advisor in the industry, and that's at finra.org, FINRA.org. So certainly check that out if you're just curious about your financial advisor and want to make sure that they've, don't have a bunch of lawsuits against them, or see how they've did on their licensing exams, etc. The FINRA website's also got a bunch of other information that is hugely helpful for investors. It's got investor alerts out there, things that they're seeing from a regulatory standpoint. If there's a new type of, scam out there, it'll list it on the website. They'll talk about, like when the Facebook IPO happened, There was an investor alert on, things to be on the lookout for, where you maybe got people who say, oh, I can get, stock before the, shares before the IPO, and they'd seen a huge uptick in that type of fraud. And so that's a great resource for, tips on things that are out there right now. It's also a place where you can go and file a regulatory complaint about your financial advisor if you're in a situation where you think that's necessary. They've got a regulatory component. FINRA is the regulatory body for the U.S. brokerage industry. So every brokerage firm in the U.S. is registered with FINRA, and they have that regulatory function where they perform audits. And if they see things that are problematic, they've got the ability to fine firms, sanction financial advisors, kick financial advisors out of the business, and even close brokerage firms. We've been involved in cases where, we're in the midst of lawsuits against the brokerage firm, and the FINRA comes in and shuts them down. And so they've got that function. The other function they have, and this gets into what we do, is they also have an arbitration forum for disputes with your financial advisor and your brokerage firm. Whether or not you realize it or not, when you establish a brokerage relationship in the United States, almost 100% of the time, there's going to be an arbitration provision buried in that customer agreement that says you waive your right to sue us in court, and instead you've got to sue us through what used to be called NASD arbitration, and now it's FINRA arbitration. And so if you are in a dispute with your financial advisor, you can't go sue them in court. If you do, they will file a motion to compel arbitration and show the judge that provision that says, nope, they've waived the right to do this. It's right here in the contract, and they'll move you into FINRA. So FINRA has that forum, which is what they use to resolve disputes with brokerage industry. It's arbitration. Our firm does it throughout the country because, unlike court, when you're dealing with arbitration, the vast majority of states say that the lawyer just has to be licensed somewhere, and they can come into their state and do an arbitration, as opposed to court, where you've got to apply pro hoc vice with a judge and ask them if it's okay. With FINRA arbitrations, I'm licensed in Florida and Illinois, but I can do those almost in every state throughout the country. And that is where all of these disputes are. So if you're in a dispute with your financial advisor, or if you think maybe you have a claim against your financial advisor, check out finra.org, and they'll have a bunch of information on the process, what arbitration is. There's the code of arbitrations on there with all the rules that are applicable. It is very different than court litigation. There's a lot of lawyers out there that are just, quote, litigators, and they think they can take on a FINRA arbitration case, and perhaps they can, but there's going to be a lot of uptick there where they're going to have to read the code of arbitration and understand the differences between arbitration and court. The big differences have to do with discovery, the documents they're entitled to. There's typically no depositions, unlike in court. That's a huge difference because FINRA arbitration hearings it's like the Wild West. You don't know what they're going to say, and they don't know what you're going to say, which is very different than court litigation. So there are some differences, excuse me, and that's discussed in the FINRA Code of Arbitration on FINRA's website. So that's another tip for today. Just if you're curious about what FINRA is, their regulatory function, their investor alerts, or even their arbitration process, check that out. If you want more information on the show or me, check out wallstreetvmainstreet.com, or you can also go to the firm website, which is whitesecuritieslaw.com. And tune in next week. We're going to be talking about a new investment that's out there that I think is potentially problematic. They're called business development companies, BDCs. And certainly if you've been recommended one, I would encourage you to tune in, as I'll talk about some of the things that I see as potentially problematic going forward. Thanks for listening.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.